All right, greetings, friends. My name is Weston Nakamura from Blockworks Macro in Tokyo. It is Thursday, June 15th, 2023, after Asia markets close, and welcome to the Market Depth Podcast, bringing you global market commentary and analysis from the Asia Pacific trading session so that you know what happened overnight. Three things we're going over to today. Number one, the Asia market reaction following the hawkish pause out of June FOMC and Chair Powell's press conference. Number two, China today, as the PBOC cuts the MLF rate by 10 basis points as widely expected, along with another slew of weak macro data out of China. And then more importantly, what is really behind the market reaction to that, and how much spillover is China's stimulus having on broader DM equities? And the answer might surprise you. And then number three, just a quick preview for the Bank of Japan tomorrow. And note that this is being recorded as we await the ECB, expected to hike rates just a few hours from now. And so you'll likely see this after the ECB is already done with. But before I get into all of that, this is something I want to show you that I tweeted as I was awaiting the Fed decision to come out that warrants repeating right now, okay? In the next 36 hours, for which we are currently right in the thick of right now, but this is essentially what we have coming on the schedule and the respective sort of market expectations, okay? We have an FOMC pause. We have a PBOC minus 10 basis point cut to the one-year MLF rate. We have the ECB 25 basis point hike expected, and then the Bank of Japan easing unchanged, okay? And all of this is following the RBA and the Bank of Canada's respective re-hiking after a period of pausing from last week. And then we also have the Bank of England next week, which I don't have included in the above. But so if you look at this full picture of global, major central banks, this current moment is the first real global policy divergence that's underway since the COVID policy convergence era, or the globally coordinated policy response, right? Which is a very significant moment for many reasons and with many implications. But the primary message that I want to drive home, especially to my fellow Americans back in the US, is it is not over after the Fed by any means. And which is another way of me saying, once again, stressing rather, do not look at the Fed or at the U.S. markets in isolation when trying to decipher what the so-called market reaction to the Fed is, okay? Markets will be trading on a relative basis to one another, and the process is still going on with central banks. So markets are currently trading without the full info. So you need to have global market context if you want to try to figure out what's behind the market behavior, which is what this episode will just really dive into, okay? So that's what I tweeted out before the FOMC policy drop. And now, looking back, seems that that approach might have helped fill some of the holes for the confusion as to why the Nasdaq rallied on Powell's press conference, as well as Powell's strange press conference in and of itself, of being both non-committal in the immediate term outlook for July FOMC, while simultaneously saying no cuts are coming for years, right? So first of all, as I always say with every single Fed meeting, and will likely continue to say going forward with every single Fed meeting, generally speaking, do not read too deeply into market price action in the immediate, nor even during or after the, Powell press conference, okay? It's not some sort of pure, reflection of actual active human market participants putting new capital to work in light of this, info that's coming out of the new policy. Of course, there might be some of that, in there, but it's by and large just a ton of just algo flows that are triggering one another in either direction, all of which has nothing to do with some word-for-word following of the chairman's sentences, as well as pre-positioning and market-on-close orders that were already placed before the FOMC decision even came out, regardless of what it is, not to mention any other market activity anywhere else that was just simply waiting until after the Fed to then execute, right? So it's just a wild mess of randomness. Not always, of course, but very often it is. And meanwhile, the following Asia markets open is the first real market reaction to the Fed, okay? And that happens after a few hours of allowing for market participants to just digest what the FOMC just released at the press conference and all of that. It's not like this word for word sort of movement that you have to decipher. Okay, but with that said, let me just give the Asia market perspective, or rather the global cross-asset macro market read and price action regarding the Nasdaq rally during the Powell presser as a potential explanation of market behavior upon the FOMC release and the press conference, okay? I actually have two theories, and so I'll just go through one by one. The second one I'll save for later. It's kind of more, I guess, sort of out there, if you will. But first, what was the broader context in markets of relevance leading into this event? Well, if you look at this chart, this is just dollar yen and the 2-year U.S. Treasury yields, and you can see that they are moving in lockstep as of late. 2-year yields, these are more or less, they reflect expectations of the policy rate, right? And they've been on a one-way march upwards. And then separately, JGB yields, Japanese government bond yields, are capped under Bank of Japan's yield curve control. So when U.S. Treasury yields move up and JGB yields are relatively static, then the U.S. to Japan yield spread widens, and when that happens, USD appreciates against JPY, which falls. So the level of correlation between dollar yen and U.S. yields, that can fluctuate at any given time, but as of the last few weeks, they have been very, very tightly correlated. And dollar yen and the Nikkei have also been extremely highly correlated in this recent upside move, okay? And so, if dollar yen and the Nikkei are correlated, and then dollar yen and the U.S. Treasury yields are also correlated, then it might imply that U.S. yields and the Nikkei have also been correlated directionally. And indeed, they are, or have been. And this isn't new, by the way. This phenomenon happens on and off for many years. And by the way, just in case this is like your first time following me, this is the part where I let you know that, yes, I know that correlation does not mean causation. I suggest you actually watch any of my previous episodes on the yuan price action and other asset classes as a phenomenon that happens coincidentally and independently of one another. Okay? I make that point again and again. So yes, I'm very aware of correlation versus causation. Okay. So, Nikkei and 2-year yields. Now, as you know, Nikkei futures and Nasdaq 100 futures have also been directionally interlocked, and in many instances, as of late, the Nikkei can indeed lead the NDX. And I did an entire segment episode on this as well from Monday, so I won't go into that now, but check that out if you've missed it. The episode is called Why is the Nasdaq Rallying? Okay, so if we zoom into the FOMC, so if a hawkish Powell press conference makes the 2-year yields surge higher, and then thereby Nikkei futures also directionally upwards, as it seems that was the case, and then if Nikkei futures can directionally lead NDX, then that might be why you get a knee-jerk algo and systematic flow-driven futures-led move higher in the Nasdaq upon a hawkish Powell. You know, maybe I'm right, maybe I'm wrong, but for anyone who's might be confused as to why people are, quote, buying the Nasdaq upon a hawkish Powell, this is exactly why I suggested having a global market context and understanding rather than just looking at U.S. markets in isolation. And because it's just systematic driven and doesn't make fundamental sense, such a move wouldn't really last once the humans come in. And they don't really come in until Asia market open a few hours later. So with that said, let's now go over to what the actual market reaction was to the FOMC starting at Asia markets open today. Again, keeping in mind that the FOMC isn't in isolation in and of itself, and Asia markets opened today into a PBOC rate decision and ECB day for the day, as well as being on the eve of a Bank of Japan policy decision, meaning there is no such thing as a clean read on the FOMC this time around, or if ever, okay? But the cleanest market read on FOMC at the moment is just simply dollar yen. And so you can see a fairly sharp move higher in spot dollar yen over the day in reaction to what happened overnight with FOMC. Okay, that reflects markets that have underestimated or have been surprised by the level of hawkishness out of the Fed, despite having them pause rate hiking itself for that June meeting. In fact, if you look at various other regions versus the yen in comparison, you'll see that actually dollar yen upside is actually underperforming the other yen crosses. So like Aussie yen, Euro yen, and so on. Meaning, just from purely a yield and policy spread perspective, if the yen is the static leg of the currency pair, due to a static yield curve capping Bank of Japan as a base to compare off of, then you can see that something like the ECB and the euro is still deemed relatively more hawkish than the Fed. Or to just get some context just as to just how hawkish the Fed is being received in the post-FOMC / pre-ECB window of time, and you can do so via these currency markets. All right, now let's move on to equity markets and that response, because once again, that final 30 minutes into U.S. cash close on an FOMC and Powell press conference afternoon is not a good market read. Okay, so here is the end of day snapshot out of Asia today. This is the picture after FOMC and after the PBOC. We see Japan flat for once, right? We see Australia slightly up, Korea's a bit down, and then we see Hong Kong and China that's up considerably. But regarding the price action, you're seeing some profit taking that began right at the PM session open today in Japan, okay, in which the Nikkei backed off from its, yet again, new 33-year high and sold down into the close and basically just back to being flat even on the day, because there are a lot of longs heading into BOJ tomorrow. In fact, this morning we actually got the latest flow data, weekly flow data from the Ministry of Finance that showed yet another week of net buying of Japan equities from foreign investors. This is data ending last Friday. So now, this week after week of consecutive buying of Japan equities by foreigners, that now is totaling to 9.3 trillion yen over now 11 straight weeks, which now makes the long Japan trend outlast the AI tech inflow trend, which recorded outflows last week, okay, as Japan equities doubled inflows week over week, and maybe at the expense of one another, or maybe not. But that leaves for a very long market into a still unknown Bank of Japan tomorrow, okay? So that's the DM market picture amidst DM central banks and the respective diverging policies announcing as we speak. Let's now discuss China and the PBOC rate cut from today. All right, so as I've been saying, DM markets have been ignoring China as it's been melting down over the last few months. And thanks to that, it's far easier to parse out China policy and market response, right? As they don't impact one another at the moment. Though that might be undergoing a significant shift, which I'll get into once again at the end of my other theory, an explanation for market price action over the last 24 hours or maybe longer. So just hold all that thought for now. Here's just kind of explanation number one. But if you're looking at China in isolation, because China has been trading in isolation, what you'll hear out of most financial media currently is that China rate cuts today is what rallied the Chinese equity markets. And I beg to differ, because as you guys know, when it comes to market price action and behavior, I have to at least attempt to correctly attach what moved with what and when. So let's just go in simple chronological order. First of all, pre-market, heading into all of this, the yuan is trading down at the AM open, as you can see, following the Fed and dollar strength. And the PBOC actually set their daily fixing slightly weaker at 9:15 a.m. local time. And so the yuan is now making new post-COVID reopen lows. Okay, and then at right here, 9:30 a.m. local time, the following three things happened at once at 9:30 a.m. Number one, that is China and Hong Kong cash equity open, market open. Okay. Number two, the PBOC lowers rates on its 1-year medium-term lending facility, or MLF rates, on 237 billion yuan by 10 basis points from 2.75% to 2.65%. That's the rate cut that was widely expected. And then number three that happened at 9:30 a.m. local time, China housing data was released. Okay, so all of those occurred at the same time. So when the Hang Seng opens up about 0.8% from last close, and then rallies up to 1.4% higher in the first 10 minutes of trading, which was the driver? What I would say is that the least likely driver is the actual MLF rate cut. Okay, because this was a done deal since Tuesday. Of absolutely zero surprise. If you recall, I discussed this earlier this week when the PBOC had cut rates also by 10 basis points on reverse repo on Tuesday pre-market open. And then they cut 10 basis points off of the SLF rates on 3 different maturities on Tuesday night, so later that evening. Okay, and due to this implicit system of like rates guiding other rates in China, this MLF rate cut by 10 basis points today was as expected and as inevitable of a sure thing as it gets with markets and policy. Okay, just as this MLF rate cut will basically mean cuts are coming by 10 basis points in loan prime rates, LPR, next week. And yes, China has a ridiculous amount of different policy rates, but this was no different from, the others that they did on Tuesday, today's rate cut. Now, if they didn't cut MLF rates this morning, then the market would cliff dive, and that could be attributed to the MLF catalyst. But honestly, this didn't do anything for markets. Okay, so next at 10 a.m. local time, we now see a potential bottom in the yuan, which, by the way, as you can see, the yuan also clearly didn't seem to care either way about MLF rate cut, in price action happening at 9:30, right? Nothing really happened there. But at 10 a.m., we got a bunch of weak macro data yet again out of China. Retail sales, miss. Industrial production, miss. Fixed asset investment, miss. And youth unemployment still has a 20 handle in China. All right, fantastic. Nothing new here either. In fact, this data like better have been bad, if you will, right? Given that this is why they're cutting rates in the first place, right? Not specifically these measures, but overall, right? That happened at 10 a.m. local time. Call it from like 10 a.m. to about 10:30 a.m., that third green arrow. We had the NBS, the China's Statistics Bureau, okay, the body that releases this data. They came out and they did a public briefing after the data came out, right after 10 a.m. And from what I can tell, they didn't necessarily like put a positive spin on what just came out per se, but they did make positive bullish comments looking forward, saying things like the Chinese economy is generally stable currently, and Q2 growth will be much faster than Q1 growth. And look, you can call that nonsense or whatever, but if that is what you're thinking right now, then what I'll say to you is that, assuming you're also of the belief that China's data isn't accurate, or let's just say is more or less made up, then if the National Bureau of Statistics of China, the official data manufacturing body, if they are saying that Q2 growth will be much faster than Q1 growth, then hell, I believe them, because that's what they'll be publishing, right? But either way, it seems that commentary may have set the intraday floor, or the range of the floor, for the Hang Seng Index downside on the day. So let's just take a look at like some of the sector performance of the day. And so initial market on open jump that you saw, so that was led by the property and development sectors. Okay, just for a moment, just for a few minutes, but nonetheless, that's what put that strong open in. And that may be due to the housing data that was one of the things that came out at 9:30 simultaneously with the rate cut and the market open itself. Now, the data itself wasn't good. I suppose, house price index finally barely positive and not negative year-over-year basis. It might be like a welcome sign. But month-over-month trend is on decline. And then from like investment data set that came out an hour later, with the rest of the data dump, real estate investment also came in below expectations, is still very weak, okay? But what really drove the Hang Seng Index as a whole? Was it because of, Xi Jinping's 70th birthday today? Maybe. But more likely, it was Hang Seng Tech, the tech sector. Mega cap tech. Alibaba, Tencent, Meituan, JD, and the like, okay? Same thing that's been getting short squeezed or long bought from the start of June. This week alone, in the past few days, the Hang Seng Tech Index is killing it. And it's just uplifting the broader index. So in other words, this is like the S&P 500, the SPXing of market breadth happening, with the largest, most liquid tech stocks surging, and on doing so on a perceived turning point in the end of a restrictive policy regime and now the start of an easing regime. It's basically the same exact thing that's happening in the S&P 500. Okay. What is moving China? Why the rally from today? Well, like I said, it's not the rate cut, and by and large, it's not the data, because neither of those are in any way new or surprising or game-changing. And furthermore, just look at the chart. The markets just muddled around in the AM session when all of this was coming out. But then you have a decisive coordinated rally in both the yuan and in equity markets, led by large cap tech that kicked off at PM open and sharply sustained into the close. Well, sort of, but maybe not in the way you think, okay? So here's where I'm going to tie everything in and present an alternative viewpoint, okay? It's going to bring in everything. China, Japan, Nasdaq, AI stocks, the mid FOMC price action, all of that together, as in my thoughts as to what I think is underway in global equity market price behavior as we speak. So clearly, first of all, there's been just a relentless buying of Japan as well as a relentless selling of China and Hong Kong. That's pretty indisputable. That's where the actual activity in equity markets has been globally year to date, right? And then of those two, between the selling of China and separately the buying of Japan, it's the latter that packs more impact. But the flows into and out of Asia are driving and having spillover effects on the other DM equity markets that have been in relatively dead in comparison. Dead markets, right? Like the absolutely breathless U.S. equity markets, as well as European equities that are just seeing outflows week after week. Japan, though, as per the foreign, flow data of 11 straight weeks of buying, right? The 1 trillion yen of buying last week alone. That is proactive capital flooding in, to which there is no other equity market or equity market theme that can say the same. Japan is where the active focus of active capital is. It's where the U.S. equity market breadth has gone to. It's where generally capital that has been brave enough to leave 5% yielding cash finds itself when it's deployed out into DM equities, as endorsed by Warren Buffett and by hedge funds and by anybody and everybody, right? The long Japan equities trade has been the equity capital magnet against all other themes, with the exception of one, and that is AI and tech, which, as I mentioned, Japan has now just recently overtaken in consecutive inflows, as tech and AI just saw its first outflows. But where did that money go after leaving AI and tech? Well, clearly the long AI capital is aggressive capital. It's not going to go from being long NVIDIA to now hiding out in treasuries or something, okay? So what I think is that much of that long AI tech outflow of recent, I think much of that found its way, or some of that found its way, into getting long China large cap tech, which to the aggressive risk taker looks like a far better opportunity to get long Alibaba, Tencent, and whatnot that got crushed year to date, rather than trying to squeeze out, some more gains out of AI. And that timing of tech and AI outflows that first started outflows and the Hang Seng tech turnaround that happened, those things happened around the same time, okay, beginning of June. Also, I'll say it's highly likely that much of that aggressive growth capital probably looks at Japan equities as a value trap, or like a value factor trade, right? And a value trap that somehow ironically just got super inflated and thereby tempting to short against. So, in a nutshell, what I think is happening is that alongside the Japan long onlys, we're also starting to see activity of long Hang Seng tech and short Japan positioning, as well as long Japan positioning and short Hang Seng on the other side. But nonetheless, the Nikkei and the Hang Seng indices may very well now be interlinked and paired. Okay, when one gets bought, the other gets sold, and vice versa. And when there is an absence of other active flows, relatively speaking, that long-short opposing pair trade can be very visible in market price action. take a look at price action of the Nikkei and the Hang Seng futures, respectively, over the last few days. Note that, the last few days in particular, if you just segment them on an intraday by intraday basis, you'll see that they actually do trade in directional opposition of one another, right? In short-term trading. In fact, that's been the broader theme basically this year, right? Like I was saying, ever since this China reopen theme was being unwound, Japan started to become this 11 consecutive weeks of foreign inflow market, right? And so if you have an allocation to Asia as an equity manager, you're going to be long the Nikkei and you're going to be short the Hang Seng, or overweight Japan and underweight China, right? And then amidst all of that activity, though, I think that the Nasdaq 100 NDX is just once again going along for the ride alongside the Nikkei, especially if much of that NDX flow is now switching out of NDX AI names and into the Hang Seng megacap tech stocks instead. If they're switching over to that, then indeed the Hang Seng and NDX are now at direct, pretty much zero-sum odds at one another, right, in terms of flows and direction. And hence, it's Nikkei and the Nasdaq 100 on one side, and then Hang Seng Tech and the Hang Seng Index on the other. Okay, and one gets bought, the other gets sold, vice versa. And then note this chart. Okay, this is the Hang Seng index versus dollar yuan inverse, right? I've shown you this a million times, and as you know, these two are supposed to be locked at the hip. But look at it lately. Since June, they just split off directionally from one another. The yuan is still, reflecting the broader China economic picture and the policy sentiment and all those things that are tied more so to, I guess, reality, right? Things that are actually happening. But the Hang Seng index or the Hang Seng futures are just an instrument that's just like a piece of a bigger structure of, global macro trading and hedging and long short and reallocations. And that are, directly now flow related with the Nikkei and NDX, the DM darlings of the year, right? And again, this isn't like Chinese investors per se. This is just global macro investors, likely mostly, US-based ones or US funds based in Singapore and Hong Kong that are trading, right? So, back to this. So why did the Hang Seng rip higher today, particularly in the PM session suddenly? It has nothing to do with China data. It has nothing to do with China monetary policy support. So what does it have to do with? Well, the Nikkei PM session open and the immediate profit taking that was happening after this incredible run right ahead of BOJ Day, that Nikkei sell flow, which is futures driven, that would thereby push Hang Seng buy flows upwards, right, in this long short structure. If the Nikkei is getting sold down, then the Hang Seng is getting bought up as a consequence of the Nikkei getting sold down. And that's why you have this PM upsurge in the Hang Seng index. Because in the AM, clearly nothing was happening regarding data or otherwise. In the PM, we saw actual directional flow out of Japan, and that's what changed for the PM session for Hong Kong. And for that matter, none of this has anything to do with the Fed either, right? Fed skip or whatever, which is a complete non-factor, as you can see displayed in markets during the FOMC press conference not even a day ago, right? And just so watch, regardless of how hawkish ECB and Lagarde is, you're either going to see the Hang Seng Tech ADRs up and Nikkei futures overnight trading down or vice versa. And if it's Nikkei down from continued profit taking ahead of BOJ, then that would likely be what's behind a Golden Dragon Index rally happening later today in the US session. Okay, so let's go to tomorrow to Bank Japan. So look, I don't know what's going to happen. I don't. Okay. But given that everybody is kind of the majority is skewed one-sided towards no change, I'm going to make the case for a change for yield curve control tomorrow. And honestly, I think it's 50-50. But here's the case for why a change may occur for tomorrow for yield curve control. Because the Fed has finally gone on hold, perhaps temporarily so, but it nonetheless has. Now, the Bank of Japan has to preserve its image, and frankly, its reality, of doing things on its own accord and not buckling to the pressure of markets and of what other central banks are doing, if they're hiking or otherwise. Well, if Powell is now giving you a window of nothingness, of being on hold, okay, and then at the same time, if you're the Bank of Japan and you don't have JGB yields that are trading above yield curve control levels and ready to burst way far above, right? And you have a smoothed out yield curve, and you have bond market functioning, that's turned around, and you also have dollar yen now just a few single digit handles away from levels that previously triggered the Ministry of Finance to unilaterally intervene into FX markets and smack dollar yen down on 2 occasions. Okay, that's where we're currently at with the currency levels. Okay, so if you have all of that lined up, and you also have Deputy Governor Uchida on record saying that any sort of change in yield curve control would have to be done by surprise by nature of yield curve control. Well, I can easily make this case, at least a 50-50 case for yield curve control shock tomorrow. Okay, it's a coin toss for me. It really is. And so that might be useless to you, but what I would push back against is this near unanimous no change that's being thrown out there. Okay, the probabilities, in my view, are not aligned with that kind of one-sided thinking. And so, personally, just being long calls on the yen futures is my play, right? The Fed did pause, after all, right? And so all we need is even just a tiny shift in sentiment for either Fed is done hiking for real and or the Bank of Japan is going to move at any time. And then you're going to get dollar yen to sink. So, and if it doesn't, you're going to have the Ministry of Finance do it for you, okay? So it's a 50-50 coin toss. I'm happy to lose 100% of my premium on my yen calls. But to bring it back to what I just said, if for any reason you get a massive Japan equity long position unwind that's been building up, then that's going to probably rally the daylights out of the Hang Seng Tech Index in the current given market dynamic that I had just explained. And nobody else can stop this foreign inflow dead in its tracks better than the Bank of Japan. So that's the real central bank of this week that matters for equity markets. So keep your eyes on Tokyo for the Bank of Japan, as well as for the press conference, as well as the currency, as well as what would come out of the Ministry of Finance should the currency start to get very much higher into the 140 handle. And most of all, keep your eyes on market depth, because I will be back tomorrow to discuss the Bank of Japan and this entire week as a whole. All right. On behalf of Blockers Macro, my name is Weston Nakamura. We will see you soon. Thank you. Bye.